And we're actually starting with you this evening. We have two companies that have their audited financials out, Image Plus Consultants and Jamaica Broilers. But let's start with Image Plus Consultants. So they're brand new. They did their IPO last year, I think it was. I think they might
December
have been,
IPO listed in
yeah, they were the
January.
last IPO since we haven't had any IPO since Image Plus. So they're the most recent one to come out. And this would be their audited financials for the year ended February 2023. So included in the IPO period a couple months after that. So how did they do, Julian?
Okay, so let's get to it. So Image Plus, they trade as Apex, and they have a similar business as Elite Diagnostics. So essentially, overall, they offer diagnostic imaging services. But as we know, imaging services have a very wide span because we need imaging services for a wide range of requests in terms of healthcare services. So accidents, pregnancies, you name it. So let's go into the financials and how the company performed for their financial year ended 2023. So in terms of their revenue growth, they're up 40.7%, and they closed at roughly 1.1 billion in revenue, in that's Jamaican dollars. And just for some perspective, they've seen their revenues grow at a 29% compounded annual growth rate since 2019. In terms of their net profit, they're up 150%, closing at 236 million. And they have compounded their net profit in terms of growth since 2019 at 74%, which is significant. And in terms of their net profit margins year over year, for the last year, which would have been their full year 2022, they closed at 12.13% in terms of the net profit margin, while for 2023, their net profit margin stood at 21.6%. So we're seeing where margins have improved, and in terms of the trend, both the revenues and profitability have grown significantly. And given that net profit has compounded faster than the revenues, it means that the business has gotten more and more cost efficient over time. That's something that we like to see in businesses. So in terms of the price, which is what many investors are interested in, so today it closed at $2.29, and that means that it would be up 14.5% from that level, i.e. from IPO price, which would have been $2, listed at $2, which was very controversial. It traded at a 52-week low of $1.72, and today's price would be a 33.1% increase from that low. And in terms of where it's trading from a PE standpoint, that's price to earnings, it's trading at 12 times, 12.05 times, and the junior market average is 17.7 times. So even though the price has started to move, it's still cheaper than the average junior market stock from a PE multiple standpoint. The dividend yield is 2.62% using today's price of $2.29, and the return on equity is 39.3%. So it's not only cheaper than the average junior market stock, it actually has a higher return on equity than the average junior market stock. So there's an opportunity there. So just to look forward in terms of the business's future. So the business has grown revenues 5 out of the last 5 financial years. It has grown net profit after tax 4 out of the last 5 financial years. It has increased scans 4 out of the last 5 financial years. It only saw a dip in 2021 because of the challenges around curfews in 2021. So they wouldn't have seen the same patient flow in that specific year. But the flip side is that they grew revenues per scan 5 out of the last 5 financial years. So even though they saw less patients in 2021, they managed to increase their revenues per scan in that year, meaning that the business is starting to generate greater value for its services each financial year on a consistent basis. So we're seeing population aging in Jamaica increase. The head of PIOJ spoke about that. So the number of persons aged 65 and over is expected to double by 2050. And according to Julia Rowe Porter, who is our head epidemiologist in Jamaica, 54% of Jamaicans are overweight. So we expect demand for these services to increase based on the data that we're seeing. And of course, we're seeing leadership internally in terms of the business.
You know, I saw a report today that says that 80 is the new old age. Old age now starts at 80. People are definitely living longer, and being in the health industry, in the medical industry, is one of those that we're all going to need. But going back to something else you said earlier, Julian, you mentioned that the IPO price, the $2, was controversial. Why was that controversial?
Well, recently being in the last year or two, we've seen a lot of listings come out at $1, but Image Plus broke that trend and came out at $2. And just from a nominal perspective, many investors would say, well, if the last 4 or 5 companies came out at $1, then why should I pay twice that amount for a new listing? What's so special about this company? But what we have to remember is that what we're paying for is a piece of a business. Companies are not priced arbitrarily. So a company can be valued against how much profit it generates per share or what its accounting value is per share. So that's the book value per share. And that is why we do valuation as investors. We want to know how much you're paying on a per share basis, because all shares are not created equal in terms of value. So is it valuable in terms of profit, or is it valuable in terms of the book value of the business, which is the accounting value, or the net worth, assets minus liabilities?
I did hear people with that concern and saying everything has been $1, but I've also wondered, what was the justification for all of these other IPOs coming out at $1? Sometimes it seemed like they were just picking $1 out of thin air because it's a popular number.
Well, sometimes investment bankers have to gauge market conditions, and it might be a case where they have assessed those market conditions. Given that interest rates have gone up significantly over the last 12 to 18 months, the appetite for equities, especially from institutional investors, wouldn't be the same compared to in 2019, for argument's sake, or 2018. So given that the appetite for equity has reduced on a relative basis, then the approach to pricing securities might have changed to increase the appeal. So if it is that institutions might not come in at levels seen 3, 4, 5 years ago, then how can I entice investors who are not institutional investors? And how can I get those investors to stretch their dollars further? So I think that's a part of the psychology. And of course, $1 is something easy to digest. I mean, to hear that something is $1, it sounds cheap. So I know that had a lot to do with what went into some of the offers. But again, the nominal price is just a part of the story, because you can have a stock at $1 that is expensive because its earnings don't match up on a per share basis. And then you can have another stock that's $1 that's cheap, because in terms of how much profit it generates per share, it's much more. So there's a difference between the price of a stock and the value of a stock. So all dollar stocks are not created equal in reality.
That is so true. Alain notes that their rival Elite Diagnostics came to market at $2 as well. So something to note. But what's your thought on how this company has performed since IPO in terms of their, not the financials, but the stock price?
Well, the company took a while to essentially pop, because normally companies that list on the JSE within a certain time frame, especially junior market companies, they tend to move within a certain time frame. So investors have become accustomed to price action that would be north of 15-20% in less than 3 months. And to some extent, investors thought that this was a disappointment because it didn't trade the way other stocks traded right after it listed. But that had a lot to do with the climate, i.e. Interest rates increasing. And even before that, there would have been offers that didn't trade the way offers prior to those would have traded. So we saw a gradual softening in terms of the IPO response leading up to Image Plus. So the disappointment in how it traded was not specific to Image Plus, but Image Plus was essentially a victim of what was already happening to other stocks before. So, for example, Ediofocal, in terms of dollar, even those stocks compared to how IPOs were trading 3 years before that, it wasn't the same. So even though investors could still get an outsized return compared to the market average on those stocks, it might have taken them a bit longer than expected. So again, when we look at the bigger picture, it's really a function of softening market conditions. And these factors were not necessarily specific to Image Plus. But given that Image Plus was listing at $2, when many of the previous offers leading right up to it were at $1, that didn't help it from a sentiment standpoint. So you had softer conditions and then something listing at twice the price. It's just like, boy, they really are coming with something that going to be at twice the price. It's harder for me to double my money. Because the idea is it's easier for $1 to go to $2 than for a $2 stock to go to $4 in a short space of time. So how quick can I double my money? That's the thought process.
And then a month later or a few weeks later, we had SSL, and there's been no IPO since. What's your thought on where the market is now? And are we ready? Is the market ready to go back to IPOs? Is it a good time now? Or do you think it's still not the best time, that we need to wait some more?
Well, I would say that market conditions have continued to soften. We're starting to see signs of life in the last couple of weeks because we notice, Fontana is on the move, Image Plus is on the move. So a lot of the trading activity is starting to happen in more specific securities. You're not seeing a market level rebound, but you're seeing a breakout in specific stocks. So if investors choose their stocks carefully, they can definitely outperform market conditions. But again, it's not like back in the day when you could close your eyes and pick a stock and essentially beat inflation. So I think that there's opportunity, but investors have to be more specific because of the environment, i.e. interest rates have gone up. There is a lot of risk as it relates to the environment, as it relates to trust. Investor trust has been broken. So there are some persons who might have come out the market to say, boy, I didn't understand this whole stocks thing from morning, and then all I hear is fraud, 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 so I don't want to touch it. So I do think there are equity offers that could come, that could comfortably fill their allocation, especially if they're small offers, i.e. if they're offers below 500 million in terms of the offer size. Yes, junior market. Mainly because investors are in a wait and see mode, especially those that never left. Persons who stayed in the market and essentially rebalanced their portfolio, took some gains and want to look at fresh assets because our market is still in its infancy. There's still asset scarcity in our market. Investors want more sectors to look at, more assets to look at so they can spread their portfolio and not have to pick the same 3, 4, 5 stocks over and over when they want to build out their portfolio. So I still think from a big picture standpoint, there's a lot of opportunity in terms of expanding the menu of investments to look at. And that is really the foundation of why I think more equity offers could appeal to investors at this time, especially if the offer is fairly small.
Well, I asked because, as you probably know, there are companies waiting to list, just looking at the market and trying to gauge when is the right time. There is one that I'm aware of that's expected this month, and it is a junior market offer. But I know all of these companies, all their bosses, their entire teams must be a little bit wary about coming to market. So there's all of that to consider. But we'll see. We'll see what happens and how they're received.
One thing to add, Kalila,
Yes, David.
it's also a function of, determining what's the best structure. Because, for example, a company could always take debt on right now and list later on at a more attractive valuation. Because that's another consideration that we have to remember. As interest rates rise, instead of you potentially selling it to, say, 20% of your company, you might need to sell 25% based on the valuation and the appetite of investors in the market as well. So pricing is one thing, but also, being able to sufficiently gauge investors to see, what's also out there. And, and Julian highlighted it as well, that you're seeing specific concentrations in stocks, but otherwise speaking, liquidity is significantly down. Like year over year, the JSE index and the value traded is down like 67%. The index is down 13%, the value traded itself and the volume down 67%. So that's kind of show you that the market is in a very peculiar place for persons who have been in the JSE within the last 4 years post-Wigton. But otherwise speaking, it's not necessarily a bad time either, because, for example, NTV Financial Group traded as low as $64 last week. Those prices haven't been seen since March 2017. So, on one hand, you have persons will take advantage of opportunities, but otherwise speaking, a lot of persons are just taking a precautionary approach, because one thing that, is of significant consideration is, if there's an emergency, I need to sell my stocks. Can I sufficiently sell my stocks without taking a heavy haircut?
Loss.
Or are there actually going to be any buyers that I can actually sell to in the first place? So there are many considerations right now in this environment. And, as Julian said, when it comes to like Apex radiologist price, some persons just couldn't do any math, because when IPO came out, from $1 to $32, $32 says at $1.75, and it was a continuous 32% increase, and the math stuck. When $2 came out, people said they couldn't do any more maths. You invest, but yet when something goes from $1 to $2 and you're doing different, the maths changes, everybody start functioning.